Hey everyone, another month, another quiet but massive signal in the gold market. While most investors were busy reacting to one of the sharpest pullbacks we've seen in years, something very different was happening behind the scenes. Gold just experienced its worst monthly drop since the 2008 financial crisis, a moment that usually triggers fear, panic selling, and uncertainty across markets. And that's exactly what we saw. Retail investors selling, ETF flows weakening, sentiment turning cautious. But here's where things get interesting. One major central bank didn't panic at all. In fact, they did the exact opposite. According to official reserve data released by the People's Bank of China, China just extended its gold buying streak to 17 consecutive months. Let that sink in. 17 months straight. Even during a sharp correction, even while prices were falling, they kept buying. And not just a symbolic amount. They added around 160,000 ounces of gold in a single month. That's roughly 5 tons quietly absorbed from the market. This comes directly from the data you provided. Now, here's the part most people completely miss. The value of China's gold reserves actually dropped significantly, from over $387 billion down to around $342 billion, simply because the market price of gold fell. But did they stop? No. Because central banks don't think in dollars, they think in ounces. They're not asking, is gold down this month? They're asking, how much physical gold can we accumulate right now? And that changes everything. This is what separates smart money from emotional money. While the market was reacting to price, China was accumulating position. And here's why this matters more than ever. This isn't a one-off move. This is part of a larger global trend. Countries like Poland, Kazakhstan, and others have also been steadily increasing their gold reserves, signaling a structural shift in how nations think about money, risk, and long-term security. Even the World Gold Council continues to project hundreds of tons of central bank buying annually, well above historical averages. So what we're seeing right now is not random. It's coordinated, strategic, and long-term. And when you step back and look at the chart of China's reserves over the last year, it's almost a straight line up, month after month, no matter what price does. This is what insiders are calling the quiet gold move, because it's not loud like headlines, but it's powerful. And in markets, this kind of consistency usually means something big is building underneath the surface. So in this first part, we've broken down exactly what happened. China added more gold. The buying streak continues. They ignored falling prices. And they focused purely on accumulation. But now comes the real question. Why are they doing this every single month? And more importantly, what does this mean for the future price of gold and your position as an investor? While most investors were reacting emotionally to a sharp drop in gold prices, the People's Bank of China kept doing the exact opposite. They kept buying. For the 17th month in a row. Now the big question is, why? Why would a major central bank keep stacking gold every single month, even during a market drop? Let's break this down in a way most people completely overlook. First, this is not about short-term profit. Central banks are not traders. They don't care if gold goes up 5% next week or down 10% next month. They are playing a completely different game, a long-term strategic game. And the first reason behind this is something you've probably heard before, but it's now accelerating faster than ever: de-dollarization. For decades, the global financial system has been dominated by the US dollar. But countries like China are slowly reducing their dependence on it. Why? Because recent global events have shown one critical reality: currencies can be weaponized. Sanctions, restrictions, frozen reserves. These are now real risks in the financial system. And gold? Gold is neutral. No government controls it. No central bank can print it. No country can freeze it. That makes it one of the most powerful reserve assets in the world. Now the second reason: geopolitical uncertainty. From ongoing tensions in the Middle East, to shifting alliances, to trade conflicts, the world is becoming more unpredictable. And in uncertain times, central banks don't want more paper assets. They want hard assets. Gold has been that safe haven for thousands of years, and today, it's becoming even more important. Third, inflation and currency protection. Even when inflation slows down temporarily, central banks understand one thing very clearly: fiat currencies lose value over time. It's not a theory, it's a long-term reality. Gold, on the other hand, has historically preserved purchasing power across decades. That's why they keep accumulating it, quietly. And finally, diversification. China holds massive reserves in US treasuries and other financial assets. Adding gold reduces overall risk. Because gold has zero counterparty risk. It doesn't depend on any government promise, it simply exists. And here's where things become even more important for you as an investor. This is not just China. According to projections from the World Gold Council, central banks are expected to buy hundreds of tons of gold again this year, well above historical averages. Countries like Poland, Kazakhstan, and others are following the same path. So this is not a single signal, this is a global trend. Now here's the key takeaway. When retail investors panic sell, central banks buy the dip. And that creates something very powerful in the market, a structural floor under gold prices. This didn't exist 10 to 15 years ago the way it does today. That's why even after a sharp drop, gold doesn't stay down for long, because there is consistent demand sitting underneath the market. And this is exactly why major institutions are still extremely bullish on gold long term. They're not just looking at charts, they're watching what central banks are doing. So what does this mean for you? It means gold is no longer just a reaction to interest rates or the dollar. It's becoming part of a global shift in how wealth is stored. And if central banks continue buying like this, the long-term direction becomes very hard to ignore. Now, this is where things start to get really serious. Because once you understand why central banks are buying gold, the next logical question is, what does this actually mean for the future price of gold? And more importantly, how big could this move really be? Let's break it down. What most investors don't realize is that gold doesn't move in a straight line. It moves in phases. Slow accumulation, then momentum builds, then suddenly, a powerful breakout. We've seen this before. After the 2008 financial crisis, gold didn't just rise overnight. It went from around $700 to nearly $1,900 over the following years. That wasn't just a rally. That was a revaluation of gold's role in the financial system. And right now, many analysts believe we could be entering a similar phase again. But this time, the drivers are even stronger. Because today, it's not just investors buying gold, it's central banks around the world. And that changes the entire structure of the market. Here's why. When central banks consistently buy gold, month after month, they are effectively removing supply from the market. That gold doesn't come back. It's locked away in reserves. Long term, sometimes for decades. So while supply gets tighter, demand keeps building. From institutions, from investors, from ETFs, and from central banks themselves. That imbalance is what drives major price moves. Now here's something even more important. Gold is no longer reacting only to interest rates. Yes, rate cuts from the Federal Reserve still matter. A weaker dollar still supports gold. But now there's a second force in play, structural demand. This is the kind of demand that doesn't disappear during corrections. It doesn't panic, it accumulates. And when you combine that with potential catalysts like future rate cuts, slowing economic growth, rising debt levels, geopolitical risks, you get the kind of environment where gold can move much higher than expected. That's exactly why major financial institutions are putting out aggressive long-term targets. We're not talking about small moves. We're talking about projections in the range of $5,000, $6,000, even higher over time. Now, will it go straight there? No. Markets never move in straight lines. There will be pullbacks, volatility, corrections. But here's the key insight. Every dip is now being met with real physical buying, and that creates a very strong foundation under the market. This is completely different from past cycles where gold depended mostly on investor sentiment. Now it has institutional and sovereign level support. And this is exactly why many analysts believe we are still in the early stages of a much larger move. So what does this mean for you? It means the game is changing. Gold is no longer just a safe haven. It's becoming a core strategic asset in the global financial system. And when something shifts at that level, the price usually follows. Now let's bring this down to what actually matters. What should you do with this information? Because it's one thing to understand that central banks are buying gold. It's another thing to position yourself correctly. Let's start with the most important reality. Gold is not about getting rich overnight. It's about protecting wealth and positioning early before major moves happen. And right now, smart money is not waiting for headlines. They're acting quietly, just like central banks. So here are the practical ways to think about this. First, if you already hold gold, you're in a strong position. Whether it's physical gold or ETFs like Spider Gold Shares or iShares Gold Trust, this kind of consistent central bank demand is a huge validation. It means there is real buying pressure underneath the market. So instead of reacting to short-term volatility, the smarter approach is to stay patient and think long-term, because corrections are part of the cycle. But the structure? That's getting stronger. Now second, if you've been waiting for the perfect entry, you might have already missed it, because what just happened, that sharp drop, was exactly the kind of dip that central banks look for. They don't chase highs, they accumulate on weakness. And that's a key mindset shift. Instead of trying to time the exact bottom, think in terms of gradual accumulation. Small positions, built over time. That's how institutions do it. Third, portfolio allocation. This is where most people either overdo it or ignore gold completely. But many institutional investors, and even guidelines from groups like the World Gold Council, suggest something very interesting. A range of around 5 to 15% of a portfolio in gold. Why? Because gold behaves differently than stocks and bonds. When markets get unstable, gold often moves independently, and that reduces overall risk. Now fourth, watch the catalysts. Even though central bank demand is strong, short-term price movements will still react to key events. Things like decisions from the Federal Reserve, inflation data, CPI reports, jobs reports, geopolitical tensions. These can create volatility. But here's the difference now. Dips created by these events are increasingly being absorbed by long-term buyers. And that's exactly what we saw last month. Finally, here's the mindset shift that separates average investors from smart money. Stop asking, is gold going up this week? Start asking, is gold becoming more important in the global system? Because if the answer is yes, then price becomes a secondary factor. Position becomes the priority. And right now, everything we're seeing, from China's 17-month buying streak to global central bank demand, is pointing in one direction. Gold is becoming a core asset again. Now let's step back and connect everything. Because what we've covered across this video isn't just another short-term gold story. This is something much bigger, a shift that's happening quietly, but consistently, right in front of us. We started with one key signal, the People's Bank of China buying gold for 17 straight months. Not reacting to price, not chasing headlines, just accumulating. Then we expanded the view, other countries doing the same. Central banks buying at levels far above historical averages, as highlighted by the World Gold Council. And suddenly, this isn't just China anymore. This is a global movement. A structural shift in how nations are thinking about money, risk, and long-term security. Now here's the most important takeaway of this entire video. Central banks are not trying to beat the market. They are trying to protect against the system itself. Against currency devaluation, rising global debt, geopolitical instability, financial system risks. And when the biggest players in the world start preparing like this, it's not something to ignore. Because historically, by the time the average investor fully understands what's happening, the move is already well underway. That's how markets work. The early phase is always quiet. Then awareness builds. Then momentum kicks in. And then suddenly, everyone is talking about it. And by then, positioning becomes much more difficult. That's why this quiet gold move matters so much, because it's happening before the majority reacts. And right now, gold is not just a hedge anymore. It's evolving into a core strategic asset in a changing global financial system. So whether you're already invested or still watching from the sidelines, the real question is not, is gold too high or too low right now? The real question is, am I positioned before the next phase begins? Because if central banks continue this level of accumulation, the long-term direction becomes harder and harder to ignore. Now, before we wrap up, if you made it this far, drop a comment below with your biggest takeaway. Are you buying gold, holding, or still waiting? Hit the like button if you want more breakdowns like this. And most importantly, make sure you're subscribed to Gold Silver Updates and turn on notifications, because we're tracking every major central bank move, every market shift, and every opportunity in gold and silver throughout 2026. Thanks for watching. Stay sharp, stay prepared, and I'll see you in the next one.